Hi, now that we've talked about what the corporate life cycle is in its different phases, and perhaps even how to identify where in the life cycle your company falls, let's talk a little about the transitions involved. What do I mean by transitions? As you move through the phases of the life cycle, there are transitions you got to make. On financing, you got to go from using your own capital to venture capital money, from venture capital to public equity, from public equity perhaps even to private equity as you get to be a mature or declining company. In terms of operating transitions, you've got to convert an idea into a product and to get from from being a startup to being a young growth company. You got to be able to scale up. With each shift, the transitions are going to be different. And finally, there are governance transitions. Initially, when you're the only owner of a company and your capital is running the company, you have to be accountable to only one person, yourself. As you age as a company and you attract external capital, whether it's from venture capital or from public equity, your governance challenges also emerge. Transitions are difficult. They're difficult for human beings, they're difficult for companies, and this session I want to focus in especially on the financing transitions. Let's talk a little bit about venture capital. To establish the basis, I want to talk a little bit about how venture capital is structured and some of the terms you might run into in the context of venture capital. When you start a business and you approach venture capital for the first time, that's called pre-seed venture capital. This is a venture capital given to businesses that might just be idea businesses. Pre-seed and seed is venture capital provided to the youngest businesses, often pre-revenue. And with each subsequent venture capital round, you get an alphabet attached to it. Series A is the first round, Series B the second round, Series C the third round. In fact, you can tell how many rounds of venture capital a company has gone to by just looking at what alphabet is attached to the most recent series. And here are some venture capital terms to get familiar with. Now, when you raise capital from venture capital, the venture capitalists ask for a share of ownership of the company in return for the venture capital. The terms of venture capital determine what the venture capital will receive in return for providing capital. Now those terms will depend a great deal on what pricing the venture capitalist attaches to your company. Notice the words are used, not valuation but pricing. Venture capital I've always defined as a pricing game. I'll give some basis for this in a minute. But venture capital pricing is what they determine the pricing of your company to be, and that pricing could be based on activity, number of users, subscribers of your pre-revenue company, or to be based on some operating metric, expected revenues, expected earnings. As we mentioned earlier, venture capital rounds reflect the fact that you are giving venture capital to a company that might have already received venture capital. Those rounds determine the terms that you get. And finally, when you look at the rounds, a round can be described as an up round or a down round. An up round is when you approach venture capitalists for more capital in a company that's already raised venture capital at a pricing higher than the previous round. That's an up round. But sometimes things turn against you. The pricing for your company might go down. That's called a down round, and that creates consequences. Because when you raise venture capital in a down round, you give away a share of the business. Existing venture capitalists are going to demand some degree of compensation, and how much you have to give them will depend on how the venture capital terms are structured. And more on that in a second. So let's talk about venture capital pricing. You might think of venture capitalists as incredibly sophisticated value people, but they're not. The way a venture capitalist attaches a pricing to a company is very simple. They take the company today, they project out a future year 3, year 5, when they think there's going to be more substance to the company. Either it started making revenues or it's even making profits. They apply a multiple to that revenues based on what other similar companies are priced at today. So let's say you expect revenues of 100 million 5 years from now, and you look around, you see that companies which are more established are trading at 5 times revenues. You multiply the 100 million in year 5 by 5 to get 500 million. That's your exit pricing. Now what you do is you discount that pricing back to today. And discount is really a loose word because discount usually reflects a discount rate that comes from fundamentals. Now, venture capitalists basically make up a hurdle rate. They come up with a number, a target rate, 30%, 50%, 70%, and made up is exactly how I would describe it, to discount back that 500 million to today. Already you can see that if you're a founder negotiating with a venture capitalist, this has nothing to do with valuation. You're going to debate two things. What will your revenues be in year 5 and what multiple to apply to it? And what target rate are you going to apply? The venture capitalists are going to apply a low multiple, give you low exit pricing and apply a high target rate, and you're going to push in the other direction. Where you end up will depend on what your bargaining power looks like. But that's what venture capitalist pricing is all about. Forecasting into a future year what revenues or earnings are going to be, applying a multiple, and then discounting back to today to come up with the pricing today. And that's going to become the key component in what share of the business you're going to demand for your capital. There are some special features that you have to keep in mind when you think about venture capital pricing. The first is you will notice this description of a pricing is either a pre-money or a post-money pricing. You're saying, what's the difference? The pre-money pricing, generically, is what a business is worth before the venture capitalist provides capital to that business. A post-money pricing is the value that you'd attach to the business after the venture capitalist provides the capital. Now let's take an extreme scenario. If you're a venture capitalist who believes that a business will be worth nothing without your capital provided, you could argue that a pre-money pricing is zero and that all of the increase in value comes from your capital. But in practice, the way you come up with pre-money and post-money numbers, there's an element of judgment involved. And I'll give you an example. If you're working with an existing pricing for a company, let's assume that you have a company priced at 100 million already. And the pricing might come from the fact that they already have venture capitalists, they have a business model in place, and you bring in 20 million in capital into the business. If I asked you what share you would demand of the business, you're going to say, the business is priced at 100 million, I'm bringing in 20 million, that's 1/5 of the business. Not so fast. Because remember, the second you bring in that 20 million, the business is now worth 100 plus 20, 120 million, your post-money pricing. And the founder could push back and say, you deserve only 1/6 of the company. Again, where you will end up will depend on bargaining power, but that's pre-money and post-money pricing. But let's say you don't have an existing pricing and a venture capitalist is pricing the company using the approach that I just described. Project out revenues in year 5, apply a multiple, discount it back. If that's the way you're coming with the pricing, a venture capitalist might argue that to get to those revenues in year 5, you need the capital infusion today. You see where this is going, right? If that is the case, the pricing you get from the venture capitalist pricing approach, discounting future exit pricing, is already a post-money pricing. And to get to the pre-money pricing, you have to subtract out the capital provided. So whether you add or subtract out the capital infusion can vary depending on what your starting number is. And that's why you often see these contradictory ways of pre-money and post-money pricing. Now, incidentally, we talked about up rounds and down rounds. Let's elaborate. Let's assume you provide 20 million in capital to that $100 million business. And let's say you end up with a 20% share of the business. You had big bargaining power. You got the pre-money pricing, so 20%. Let's say this business's pricing drops from 100 million down to 60 million. Things work against them. The business model doesn't work as well. They go out and raise another 20 million in capital. That person is now going to demand 1/3 of the company because the pricing has dropped from 100 to 60 million. As the existing owner of 20% of the business, you're now going to find yourself diluted because the new venture capitalist got much better pricing terms than you did. You know what venture capitalists do? They build in protections against down rounds. In other words, if the owner now goes out and raises an extra 20 million at lower pricing, they now have to compensate you, the existing venture capitalist, by giving you a bigger share of the business. Those are built into the venture capital terms. They're not, you can't come up with them after the fact. But venture capital terms often include protections against down rounds. So pre-money versus post-money, and these protections built in have to be understood when you think about venture capital terms. That's probably why when you look at a venture capital round at a company, it's very difficult to go from that venture capital round to what a company is worth. What I mean by this is you'll often see a Wall Street Journal report that says such and such company raised 50 million and in return gave away 5%. And if I asked you, how much is the company worth? You're saying 50 million is 5%. The company must be worth $1 billion. Not necessarily. Because to invest that 50 million, maybe I got the 5% and protections, in which case the true business value is much less than $1 billion. So it is very difficult to extrapolate from venture capital rounds to actual pricing because of the pre-money, post-money, and the VC protections. So that's a first transition from your own capital to venture capital. And venture capital funding changes over time. People assume that venture capital is somehow a tap that stays open all the time, but that's not the case. The amount of access you have to venture capital shifts over time. In good markets, there's lots of venture capital. Bad markets, it shrinks. This graph looks at venture capital funding each year by year going back to the mid-1980s. You can see the build-up in the 1990s. That's a dot-com boom. And then you see the dot-com bust. And you see venture capital is fading after the dot-com boom, coming back again until 2008, fading again, rising in the last decade. This graph ends in 2021, but there was a big drop-off in 2022. Why? The economy slowed, inflation came back. Venture capital is risk capital. Risk capital ebbs and flows. What does it mean though as a startup? If you're in a healthy venture capital market, it's easier at least for you to raise capital if you need it. But if you get caught up in one of these down years for venture capital, you can get very quickly strapped because you will not be able to raise capital because there isn't enough around. In terms of trends in venture capital, the first thing to recognize is while venture capital as a capital source was born and nurtured in the US, it is now a global phenomenon. I mean, there is venture capital in Asia and Latin America, so you see venture capital is a much more which effectively also means that you're now competing against the rest of the globe if you're seeking out venture capital. The investor makeup has also changed. In its original form, venture capital was either run by venture capital funds or when investors invested was primarily institutional. So venture capital funds would go to endowment funds and institutions and offer themselves as an alternative investment group. So if you have $1 billion to invest, they'd say invest 50 million in venture capital. So primarily institutional. But over the last decade or so, you see inroads made by individual and retail investors. Some of the innovations are technological, but you now see smaller investors also being included in the game, which is a plus and a minus, because this is a game where it's very easy to get hurt if you're a passive investor. And finally, corporate venture capital is now a bigger part of the game than ever before, for two reasons. The first is the growth in healthcare and technology companies, where rather than make capital investments internally, which took the form of R&D, these companies have learned that it might be more efficient to actually buy stakes in small companies, other companies, and hope that some of those stakes pay off. So in other words, it's become their way of reinvesting is rather than internal reinvestment, they make investments in outside companies. The second reason for the growth in corporate venture capital is the increasing cash balances at some of the biggest companies. Tech companies in particular, the large tech companies have cash balances of $100, $150, $200 billion. And that money is often looking for a place to go. So not surprisingly, the big tech companies are running venture capital arms on the side because they have the capital to do so. So venture capital has changed as a game, but it's still that first step that companies take as they want to grow when you go from purely founder or owner capital to external capital. The second transition, of course, is from private company to public company, the process being an initial public offering. Why would you do it? Because you think you're getting better terms from public markets than from private investors, and also to allow existing investors to cash out. That said, though, there is a trade-off in going public. One is the disclosure requirements in public companies are much more onerous than the disclosure requirements in private companies. So as you go public, you got to think about those disclosure requirements. The second is once you go public, you are accountable to the shareholders in your company. Initially, as a founder, you might you might bask in that glory of being a founder, but if your revenues and earnings and cash flows don't come in as expected, you should expect to see pressure build up. And for some companies, that pressure can lead them to do things that are not in the best interest, long-term interest of the company. So information disclosure and the need to keep public market investors happy might be factors that keep companies private for longer. Incidentally, that process of staying private for longer has become easier in the last 20 years because of a gray market that's opened up. And we'll talk more about this in future sessions. The gray market being this market where you could stay private and raise billions of dollars from not just venture capitalists, but from public market investors. Uber, for instance, in 2016 was still a private company, raised billions of dollars from the Saudi investment fund, as well as Fidelity and T. Rowe Price, public market investors, because they viewed it as a way of making higher returns for their investors. Now, when you think about going public, the traditional way of going public was banker-led. So this is where the way the process unfolded. If you're a private business that plans to go public, you found a banker, a lead investment banker, Goldman Sachs or Morgan Stanley. Why? Because those bankers gave you credibility, they managed the process. That banker then would create a syndicate of other bankers. They would set a preliminary price based upon your financials and your prospects. And then they would also define a final offering price that they would guarantee. Sounds like a great deal, right? Guaranteed price. Now that guaranteed price was of course set lower than what they thought the market would be willing to pay because they had to provide a buffer. They would manage the process, have a roadshow. So if you look at what bankers did, bankers provided companies that markets didn't recognize with credibility. They priced the company, they sold the shares to their clients, and then they managed the trading right after the company goes public. So that used to be the IPO process for much of the last century. This process, though, has catches. First, the banker doesn't do it for nothing. They demand a fee. That fee can be 3, 4, 5% of the issuance proceeds. So a significant piece of what you raise goes to the banker. The second is because the banker guarantees a price, that offering price is often set below the price that the market is willing to pay. And the way this manifests itself is on the offering day, the stock price tends to jump. We'll talk more about this process as we go through the session, but that means you're leaving money on the table as a founder or a venture capitalist because the stocks are underpriced. So it's expensive and it's underpriced, but people are willing to go along because they got the marketing, the credibility, and the organization from bankers of selling your shares. Increasingly, though, people have looked at this process and said, what am I getting for my money? I mean, first, let's look at the credibility part. If you're Facebook going public, Morgan Stanley might be a banker. I would argue more people have heard of Facebook than Morgan Stanley. So I'm not sure a banker adds much credibility. The pricing part, people have recognized very quickly that bankers are not that great at pricing. How do we know? Because when your stock price jumps 50 or 80% on the offering day, that's an indication that you got the pricing wrong. And the marketing in today's day and age, you might get better marketing by using a social media celebrity rather than having a banker get on a phone and call portfolio managers and investors. I'm not arguing that bankers don't add anything to the process, but the benefits you get from using a banker have decreased over time, and people are starting to look for alternatives. Here's one. It's called a direct listing. In a direct listing, as a company that wants to go public, rather than go through a banker who sets an offering price, you don't set a price. You open up to demand and supply and let the market set the price. Now, of course, you say, how would markets set price on a company they've never heard of? Clearly, to do a direct listing, you got to get the information out there and trust markets to make a judgment. But here's what you gain. First, you don't have to pay a banker. And second, the market price is the market price. You're not discounting the price and offering it at a lower price than the market is paying. No money left on the table. The problem with direct listings is, at least as it stands now, if you make a direct listing and you raise cash, which is what many companies want to do on an offering day in an IPO, you cannot keep that cash. That cash has to be cashed out by owners in the company. So that has acted as an impediment to direct listings taking off, but it's an alternative in the IPO process to using bankers. There's a third way in which companies have gone public in the last few years, which is through SPACs. A SPAC is a special purpose entity where essentially you create a company with no purpose first. You say, why would people invest in the company? Because the names at the top of the company. They're celebrity investors, people that other investors look to and say, those people know more than I knew, they're experts. So you create a SPAC. You go public, you raise capital. Right now, you have no use for the capital. You say, why would I, what do you do with the money? The SPAC now goes looking for private companies to buy. And here you're trusting the expert you've given this money to find you a company that's going public at a bargain price. You can already see that the SPAC process is built on trusting an expert to find companies which are cheap and finding the right companies to invest in. Once they find the company, they merge that private company with the public company that's already out there. And that becomes now, so the shell company is now filled in with the private company financials and operating assets. Now, the problem with SPACs has always been that that there's a potential for self-dealing here, because the people who create these SPACs often keep a significant amount of the capital raised by the SPAC for themselves. I mean, the number can be as high as 15 to 20%, which means that you have to make enough money on the remaining 80% to cover the 20% you left on the table. That's really tough to do. And SPACs have had a kind of a checkered history. There's a potential for SPACs to survive if that 20% becomes 4 or 3 or 2%. But at 20%, it's really tough to see how you as an investor is going to be able, so if you're not the sponsor, how you can end up walking away with winnings. But the IPO process is now in being disrupted itself. Be interesting to see how the process plays out. Incidentally, if you look over time, the way people describe IPO markets is like hot and cold markets. So just as you saw with venture capitalists, there are up years and down years. In fact, if you look at this graph in conjunction with the venture capital graph, you'll often see that the good years kind of match up. 1990s, lots of IPOs. Then the dot-com boom crashes, IPOs go away. Then you see the surge again through 2008, again the drop-off, again the rise between the last decade. And so risk capital is risk capital, whether it's in the form of venture capital money or IPO money. You see the ups and downs over time. Now, incidentally, the kinds of companies going public have changed over time. This graph, I look at two numbers. One is the revenues of a typical company going public and whether it's making money. You go back to the 1980s, you see that the typical company going public was much smaller in terms of revenues, but more of them were money making. Both Apple and Microsoft, which went public in the 1980s, were small revenue companies, but were making money. What's changed? First, is the typical company going public in the last decade has been much bigger in terms of revenues. They've scaled up more, but far more of them are money losing. Put simply, you're getting companies scaling up without business models before going public, and markets have become okay with that. And that might have consequences. When you think about the investing side, what does it mean? We'll come back and look at the investing implications. But the kinds of companies going public have clearly shifted. They're larger and more likely to be money losing. So we've talked about venture capital. We've talked about going public. Let's talk about what happens once a company is already public. It still needs capital, right? To grow. Where does it get the capital? This graph, I look at the sources of capital for companies that are already public. And this probably doesn't come as a surprise. But if you look across the years, 65, 70, 75% of the capital needed for growth and reinvestment comes from internal earnings. What does that mean? When you've heard the term retained earnings, which is an accounting term, you make money as a company, some of it gets reinvested back in the company. That remains the primary source of capital once companies go public, is internal earnings. And if they have to look outside for more capital, they're more likely to raise that capital through bonds than through stocks. You're saying, why? Here's one reason. The issuance cost of raising equity is much greater than the issuance cost of raising bonds. In this graph, I look at the cost of issuing bonds, that's the green column, and the cost of raising equity. And two things come out. One is across the board, it's cheaper to raise capital with debt than with equity. And the second is, if you're a larger company, your costs are lower than if you're a smaller company. So one reason companies are reluctant to issue additional equity once they go public is the issuance cost. There is a way around that issuance cost, though, which European companies are more likely to use than US companies, and that's to use what's called a rights issue. What's a rights issue? In a rights issue, you go to existing shareholders in your company. Remember, you're already a publicly traded company. You offer them additional shares in your company at a discounted price. But it's not a big deal. Everybody gets the same discount. So share price is $10. You give them the right to buy an additional share at $5. And you also give them away, if they don't want to use that right, to sell that right to others. The biggest benefit of a rights offering is you're able to raise equity without that issuance cost you had when you decide to issue fresh shares the traditional way. US companies have been reluctant to make rights offerings because of a bogeyman called dilution. Bankers make a big deal about it, how your per share numbers are going to drop down. Completely meaningless when everybody gets those discounted shares, but it still has held back US companies from making rights issues. So that's if you're a public company raising capital, more likely to be debt than equity. And with equity, it'd be cheaper if you use rights offerings than by issuing shares. But let's say you're now a mature, declining company and you decide you want to go private again. If you look at what companies get targeted by private equity, so what kinds of publicly traded companies get targeted by private equity, they tend to be companies where there's potential for the private equity investor to borrow money. So first you will notice that more lightly levered companies with less debt, are targeted more often than companies with more debt. And companies that actually are not delivering much in terms of EBITDA, where you think there's a potential, if this company was run better, to increase their earnings and their cash flows. Now what happens in a public to private deal? You take a public company where the public owns, let's say 96% of the shares, and the private equity investors buy out that 96% with what? With a portion of it being their equity and the rest being borrowed money or other people's equity. In other words, they've replaced the public equity with private equity and debt. Often they try to keep the management team on because then the management can, kind of lubricate this process and allow it to go through. You've taken a public company, you've taken it back private. In other words, you reversed what led you to becoming public in the first place when you were a young growth company and you said my terms would be better by going public. You're now reversing it by becoming a private equity firm. You say, what does private equity do with these publicly traded firms? Once these firms have gone back to being private, the private equity firm tries to fix these firms. By doing what? By either making changes in operations, becoming more efficient, selling off assets that they think are tangential, and borrowing money while they do this. And they try to fix a company. And they hope to take this fixed company back public again. And this is key to remember. The definition of success for a private equity investor is not to take a public company private and keep it private, but to flip it back to being public at a much higher price. Are there risks involved? Of course. And here are some of the risks. First, you could pick the wrong target. You might be picking a target where you think they're operating inefficiencies when in fact the business has turned bad. Or you might pay too high a price. During the period of trying to fix this company, you might sell off the wrong assets. You might take on too much debt. And if there is an economic recession, you could go bankrupt. And then when you try to take it back public, people might not be as excited about the company as you are. We look at the success timeline for private equity investors, but the process is a simple one. You've taken the public company to being private, you try to fix it as a private company, and then flip it back to being a public company. And along the way, you do earn management fees and other benefits while you're running the company as a private equity, a sponsor. Again, as with venture capital and IPOs, there are trend lines for private equity, but these trend lines might not match up to the trend lines that you see for venture capital and IPO. And the reason is simple. Venture capital and IPOs tend to be focused in on the younger phase of the corporate life cycle, younger companies, private equity tends to be focused on mature and declining companies. So there's a cycle here, but the cycle tends to be a different one. As with venture capital and with IPOs, there have been shifts in the way private equity invests over the last few decades. The first is you've seen a trending towards bigger deals. When private equity was first started, the deals tended to be over smaller companies. The size of deals has become larger over time. The second is deals have increasingly globalized. Initially, private equity was almost entirely focused on US companies. It's now a global phenomenon. And third, and this is, I think, a healthy shift. Early on, private equity was almost entirely focused on leverage financing the deal. Every buyout was a leverage buyout, though that wasn't always the right thing to do. Over time, I think private equity has recognized there are some deals that are better funded with equity than with the debt. And that has shifted the way deals have been financed over time. I hope you found this session useful, and thank you very much for listening.